Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 17th of April. I'm Daniel Lam, your host for the podcast. This week is going to be a data-heavy week. Starting from Tuesday, we will be getting the China GDP, IP, and retail sales figures. Later in the week, we will get the ECB meeting minutes, as well as the US Beige Book. And finally, important PMI figures in the US, Europe, and the UK will be coming this Friday. Of course, another area of focus for investors would be the first quarter US earnings season. Last Friday, a number of the mega large cap financials reported earnings that beat expectations. And the reporting on the financials will be continuing this week. Investors will be watching this sector heavily to look for indications of a quote-unquote return to health in the banking sector, which was shaken up by events last month. Now, S&P 500 first quarter earnings are expected to fall overall by 5.2% year-on-year. This compares with expectations of a 1% rise at the start of January. This will mark the second consecutive quarter of earnings decline, i.e., technically an earnings recession, while profit margins are expected to fall. A cocktail of still elevated inflation and slowing growth has created a challenging environment for companies. So only 4 out of 11 S&P 500 sectors are expected to show positive earnings growth. They are consumer discretionary, industrials, energy, and financials. So therefore, we continue to take a defensive sector stance on US markets, preferring consumer staples, healthcare, and utilities sectors. Historically, they have shown the least earnings volatility even during recessions compared to other sectors. In terms of technicals, the S&P 500 index has been benefiting from expectations of a potential pause in Fed rate hikes. It's been rebounding and has broken above the important resistance at 4,100. However, we do see strong resistance ahead at 4,300, and we maintain our neutral view on US equities. Once again, we advocate our safe strategy, with US 10-year yield facing resistance at 3.6%. We like bonds over equities and continue to see multi-asset income strategies as an attractive and diversified way to navigate a challenging global growth outlook. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.